Every day, millions of dollars change hands as market participants wrestle with one fundamental question. Should you buy a slice of a revolutionary company promising to change the world tomorrow, or should you quietly purchase a forgotten, unglamorous business that is trading for less than its actual worth today? This is not just a theoretical debate for Wall Street analysts. It is the defining fault line of the stock market, separating two entirely different philosophies of wealth creation. Understanding this divide is the first crucial play in mastering your financial future. The financial landscape is essentially split into two dominant camps. On one side, we find the disciples of value, meticulously searching the market for discarded bargains and mispriced assets. On the other side stand the champions of growth, aggressively hunting for the next massive technological leap or consumer trend, willing to pay a premium for high potential. Neither approach is inherently wrong, but choosing one without understanding its mechanics is like walking onto a playing field without knowing the rules of the game. We need to dissect these strategies to build a resilient portfolio. The roots of the first strategy stretch back to the aftermath of the Great Depression, pioneered by an economist named Benjamin Graham. He transformed the chaotic, speculative nature of early stock markets into a disciplined, mathematical science. Graham believed that every public company has an intrinsic worth, a true, underlying value based on its hard assets, cash flow, and steady earnings. His strategy was stunningly simple in theory, but demanded immense psychological discipline in practice. He instructed his followers to only buy a stock when its market price fell significantly below that calculated true value. This gap between the market price and the actual worth creates what Graham famously called a margin of safety. Think of it like buying a dollar bill for 60 cents. If your calculations are slightly off, or if the broader economy stumbles, that 40-cent discount protects your initial capital. Value investing is fundamentally pessimistic about market efficiency. It assumes that human emotion, panic, and short-term thinking frequently cause perfectly good companies to be priced as if they are going out of business. The value investor profits by stepping in when others are running away. Applying this methodology today requires looking past flashy headlines and digging into the financial statements. A core play for this strategy involves examining metrics like the price-to-earnings ratio, which measures how much you are paying for every dollar of profit the company generates. Value hunters look for ratios that are significantly lower than the historical average or the broader market. They also frequently seek out companies that pay consistent dividends, providing a steady stream of cash return while they wait patiently for the market to eventually recognize the true value of the underlying business. The most famous practitioner of this discipline, Warren Buffett, took his mentor's framework and adapted it for modern markets. Instead of just looking for mediocre companies trading at extreme discounts, he shifted the focus to finding wonderful, highly profitable businesses trading at fair or slightly discounted prices. This evolution recognized that a strong brand, a loyal customer base, and a dominant market position also possess immense intrinsic worth. The focus remained squarely on buying established cash flow, but the definition of what constituted a bargain expanded to include long-term competitive advantages. Adopting this mindset completely changes how you interact with your investments. You stop viewing a stock as a blinking ticker symbol on a screen that you hope someone else will buy for a higher price tomorrow. Instead, you begin to view yourself as a fractional owner of a real business, with real employees, real products, and real revenues. This psychological shift is incredibly empowering. When the market inevitably dips, the business owner does not panic. They simply evaluate whether the underlying enterprise is still sound, often using the downturn as an opportunity to acquire more shares on sale. Yet for all its proven historical success, the bargain hunting approach is not the only way to build lasting wealth. While some investors are busy combing through the discount bin, another completely different breed of market participant is looking toward the horizon. They are not interested in buying mature, slow-moving businesses for a slight discount. They want to capture the exponential, world-changing expansion of the future. This brings us to the second major strategy in our playbook, an approach defined by its relentless pursuit of scale and innovation. Growth investing focuses on companies that exhibit high potential for rapid expansion, often significantly outpacing the average growth rate of the broader economy. These are the disruptors, the innovators, and the pioneers. Whether they are developing revolutionary software, creating new medical treatments, or changing how we shop, these businesses share a common characteristic. They typically reinvest every single dollar of profit right back into the company to fuel further expansion, hire more engineers, or capture more market share. They are building the infrastructure for tomorrow. Because these companies are prioritizing massive future scale over current profitability, traditional valuation metrics often make them look incredibly expensive. A growth investor might willingly pay a massive premium, accepting a sky-high price-to-earnings ratio, because they believe the company's revenue will multiply several times over in the coming years. The strategy relies on identifying the fundamental shifts in human behavior or technology before the rest of the world fully prices them in. The ultimate goal is not a 20% discount, but a stock that might increase in value by 500 or 1,000% over a decade. The macroeconomic environment plays a massive role in the success of these high-flying companies. When central banks keep interest rates exceptionally low, money becomes cheap to borrow. This cheap capital acts as rocket fuel for businesses that need to burn through cash to fund their rapid expansion. In these specific economic climates, investors are heavily incentivized to take on more risk, pushing the valuations of innovative companies to staggering heights. We have seen entire decades where this aggressive expansion strategy completely dominated the financial landscape, leaving traditional bargain hunters in the dust. However, chasing high potential carries immense and unique dangers. When you pay a massive premium for future success, the market's expectations become ruthlessly unforgiving. If an innovative tech company reports revenue growth of 30%, but Wall Street was expecting 40%, the stock price can instantly collapse, wiping out billions of dollars in wealth in a single afternoon. The penalty for merely being good instead of spectacular is severe. Growth investors must constantly monitor their holdings to ensure the original thesis for expansion remains completely intact, because the margin for error is virtually non-existent. The bargain hunters face their own distinct set of hazards, most notably the dreaded value trap. This occurs when a stock looks incredibly cheap on paper, trading at a massive discount to its historical averages, but the underlying business is actually in terminal decline. Perhaps their core product has become obsolete, or they are drowning in unmanageable debt. The stock is cheap because it deserves to be cheap. Investors who blindly buy, based only on low valuation metrics, without investigating the qualitative health of the business, often find themselves holding a dying asset that will never recover. If we examine the broader history of the financial markets, we see a continuous, cyclical tug-of-war between these two distinct philosophies. There are prolonged eras, sometimes lasting a decade or more, where rapid technological advancement and cheap capital make the innovators the undisputed kings of the market. Then, the economic winds shift, interest rates rise, capital becomes expensive, and investors suddenly demand immediate cash flow and proven profitability. In these harsher environments, the steady, dividend-paying, undervalued businesses roar back to life, reclaiming market leadership and punishing those who overpaid for promises. Recognizing this cyclical nature is crucial, but attempting to perfectly time these massive shifts is a fool's errand. Even the most sophisticated institutional analysts, armed with supercomputers and endless economic data, routinely fail to predict exactly when the market will rotate from favoring expansion to favoring bargains. If you constantly sell your holdings to chase whichever strategy is currently winning, you will inevitably incur massive tax penalties, rack up trading fees, and almost certainly buy at the top and sell at the bottom. The strategic play is not timing the cycle, but preparing for it. This preparation requires mastering diversification, the practice of spreading your risk across different types of assets to ensure that a single failure does not derail your financial future. A truly robust portfolio does not pledge blind allegiance to just one camp. By consciously holding both underpriced, stable businesses and high-potential innovators, you create a financial engine that can generate wealth regardless of which way the economic winds are blowing. When one side of your portfolio is struggling through a hostile environment, the other side is typically providing stability or driving your returns forward. Implementing this dual approach has never been easier for the everyday individual thanks to ETFs. These exchange-traded funds are essentially massive baskets of individual stocks that trade together as a single unit. You can purchase one fund that strictly holds hundreds of undervalued dividend-paying companies, and simultaneously purchase another fund dedicated entirely to rapidly expanding technology and healthcare disruptors. This allows you to capture the distinct advantages of both investment styles without ever needing to read a single corporate balance sheet or guess which specific company will win the race. The exact balance you strike between these two forces must be deeply personal, dictated by your specific timeline and your stomach for volatility. A young professional with 4 decades until retirement might heavily tilt their strategy toward rapid expansion, knowing they have the time to recover from the inevitable severe market crashes that accompany high-flying stocks. Conversely, someone approaching their final working years must prioritize capital preservation and steady income, making the margin of safety offered by undervalued cash-producing businesses far more attractive than the wild swings of the innovation sector. Regardless of exactly how you allocate your capital, the ultimate fuel for both strategies is compound interest. This is the mathematical phenomenon where the money your investments earn begins to generate its own earnings, creating a snowball effect of wealth over long periods. Whether those returns come from the explosive capital appreciation of a tech giant or the quiet, steady reinvestment of quarterly dividends from an undervalued railroad, time is the critical ingredient. The true magic of compounding only reveals itself to those who have the discipline to leave their capital untouched through multiple market cycles. We must also factor in the silent thief of wealth known as inflation, the gradual loss of purchasing power as the cost of goods and services rises over time. Both strategies offer unique defenses against this economic reality. Companies with high pricing power, often found in the value category, can simply raise their prices to match inflation, protecting their profit margins. Meanwhile, the explosive revenue increases of successful growth companies can drastically outpace the rate of inflation, preserving and expanding your real wealth even as the currency itself loses value. History provides stark lessons on what happens when these principles are ignored. The turn of the millennium witnessed a spectacular frenzy where investors abandoned all concept of intrinsic worth, pouring trillions into internet startups with no revenue and no viable business models. The subsequent crash vaporized massive amounts of wealth, a brutal reminder of the dangers of unchecked speculation. Yet, from the ashes of that devastating collapse, the disciplined bargain hunters quietly went to work, scooping up the surviving fundamentally sound companies at historically low prices, setting the stage for massive future returns. The most successful wealth builders understand that strict labels are ultimately limiting. You do not have to tattoo one specific philosophy on your forehead and ignore all other opportunities. The market is a dynamic, ever-changing ecosystem, and your playbook must be adaptable. By stripping away the tribalism that often plagues financial media, you empower yourself to simply look for the best risk-adjusted returns available. Whether that takes the form of a forgotten manufacturing plant trading for pennies on the dollar, or a revolutionary software platform trading at a premium. In fact, many modern strategists actively blend the two approaches, seeking out companies that offer a reasonable compromise. They look for businesses that are expanding their revenues faster than the broader economy, but whose stock prices have not yet been inflated to completely irrational levels by market hype. This hybrid approach requires diligent research and a deep understanding of both valuation metrics and industry trends, but it represents a powerful middle ground for those who want to participate in the future without completely abandoning the safety net of mathematical discipline. Your next strategic play is to audit your own financial landscape. Look closely at your retirement accounts, your brokerage holdings, and your long-term plans. Are you unknowingly concentrated entirely in highly volatile innovators, exposing yourself to massive risk if the economic environment shifts? Or are you trapped entirely in slow-moving, mature businesses, severely limiting your ability to outpace inflation and build generational wealth? Adjusting your asset allocation to reflect a deliberate, conscious balance between these two philosophies is a critical step in taking active control of your financial destiny. Mastering the mechanics of capital allocation is not about possessing a crystal ball or predicting the future. It is about building a resilient, adaptable framework that can withstand the inevitable shocks of the global economy while steadily advancing toward your goals. Whether you lean toward the quiet discipline of the bargain hunter or the bold vision of the innovator, the true keys to the kingdom remain constant. By committing to continuous learning, maintaining emotional control during market panics, and letting the math work over decades, you secure the ultimate prize of true financial independence.